Happy Sunday and welcome back, my passive income investors. Today, I want to get into Canadian dividend stocks, whether you're on the US side of the border or the Canadian side of the border. You're probably well prevalent that Canadian companies trade at crazy discounts and compared to any kind of US counterpart. And a lot of people are unaware or maybe even under diversified, depending on what perspective you're coming from. So I want to get into this today, talking about tax advantages for Canadians specifically. I want to talk about tax advantage accounts, how to take advantage of some of this stuff, because I've been getting a lot of questions recently about how to properly utilize a TFSA. Is it actually intelligent to be primarily owning Canadian stocks in a TFSA when you might want to take more advantage of tax benefits of owning US companies? Because whether you're buying over the border, you don't want to be buying foreign companies in regular brokerage accounts because it does come with other issues, especially if you're focusing on dividends specifically. And then we're going to get into a Q&A as well. But let me kick this off by saying I find it absolutely hilarious that Canada is one of the fastest first world growing nations, yet the stocks here trade at relative discounts to every US counterpart, whether you're looking at banks. I just did an example yesterday of something like Stag Industrial. One of my favorite US real estate investment trusts has a Canadian counterpart called Granite Real Estate Investment Trust. Granite trades for a PE of like 10 or 11, and Stag trades for a PE of getting into the higher 30s now. And look at the banks. I mean, go take a look at JP Morgan and compare it to something like a Canadian Imperial Bank, which just introduced fractional share buying, which is one of my favorite Canadian banks because it's also the highest yielding Canadian dividend bank. But let's start winding this back a little bit. I want to talk about some of the tax implications first, how I've had to approach this coming from the Canadian side of the border, because let's say you want to buy, and you're in the US even, and you want to buy a Canadian company because you're like, damn, these Canadian banks kicking out 5% yields. I don't want to own a Bank of America that's paying a 2%. I'd rather kick into this economy Kyle's talking about that's growing super fast and is going to continue to expand. So if you were to buy any kind of these companies, you're going to get slapped with a 15% withholding tax on the dividend income, which is really interesting because this tax is not implicated on, say, capital gains. So it's really interesting that if you're buying any kind of a stock, whether you're Canadian or US, buying over the border, you have to calculate in or minus 15% of that 5% tax. So, for example, I want to buy a company called MPW is the ticker. It's a medical properties trust, and I'm going to be buying it in my tax advantaged account. But even though I'm doing that, I'm still going to have to pay withholding tax. So I think medical properties, when I was calculating, was paying like a 5.5% yield, maybe a 5.3 or 4 right now. But if you minus out roughly 15%, that would be about 0.8% of that total dividend, meaning, you're minusing, say, whatever the dividend is, 5.4, 5.5, you're actually getting closer to about a 4.5, 4.6% yield, give or take, right? A couple points there. But that's drastically different, especially if you're buying it in, say, a regular brokerage account, because if you're buying it that way, now not only are you slapped with a 15% withholding tax, but now you have to pay income tax. And if you're buying a REIT, for example, REITs are taxed at the highest bracket because the government looks at it as regular income. So now you're paying 15% plus your marginal income bracket, which is likely going to be 30 or 40%. So realistically, you do not want to be approaching dividend stocks in any facet, in my opinion, through regular brokerage accounts. You lose so much of it that you might as well focus on capital gains, because capital gains tax is beautifully taxed at a much different way, right? So let me just try not to get too complicated and jump this up. I know it's Sunday here, guys, and this is a pretty intense conversation for a Sunday, but that's a good example, because if you're buying, say, if you're Canadian or US and you want that foreign exposure and you want that foreign income, you have to be doing it through a tax advantaged account. It's just so illogical to do it in any other way, because again, like why lose 40 or 50% of the dividend when you could buy it, say, in a TFSA or your 401k, where you're only paying the over the border tax, and now you're not getting slapped with an income tax bracket. So that's kind of like one way to look at it. And a lot of people that are new to, say, a tax-free savings account, it's my favorite thing as a Canadian, because the US counterparts like your 401k and your Roth IRA are not even closely comparable. Your tax-free savings account is something Kevin O'Leary should talk about a lot more often, because it's part of my favorite wording when you get to say tax-free income in perpetuity for the rest of your life without it ever affecting your income bracket as well. So the tax-free umbrella allows you to pay tax on your money up front, put it into that account, all the money it now generates in perpetuity for the rest of your life is going to be tax-free, aside from some things like withholding tax, depending on the companies you're holding. But if you pull that money out, it does not affect your income tax bracket. So if you're buying dividend stocks, you can use those dividends today and not have it affect anything, not pay any income tax or anything like that, which is wonderful, right? But that's the TFSA. But then we also have something called an RRSP, a registered retirement savings plan. I do not like this account at all. It's not one of my favorite accounts because, like in the US, you can't pull against that money until you're at retirement age of 65 without getting slapped with huge fines. Like, you pay, I think, a 15 or 20% fine on the first 5,000 that you pull out of your RSP if it's done prematurely. But what the RSP does is, if you take capital that you're making and you put it in that account, the government deducts it from your income. You don't pay tax on it, and it lowers your income tax bracket for the near term. And the coolest thing about an RRSP that kind of blows my mind is you pay no withholding tax. So a lot of people like buying their US companies within the RRSP, and I take advantage of this because I buy companies that I don't want to touch for the next 30 years. So I'm buying things like Johnson and Johnson, Clorox, what's the other one that I have in there? Pepsi, like companies that I don't really need to utilize the dividends today. And I trust that these companies are going to be around for the next 35 years. Now, I would focus on that secondary because like I said, if you're like me trying to fast track your financial independence to maybe one day retire early, the RRSP is not the approach you want to take. However, if you're making really good money, always take advantage of it, always max it out, because at the end of the day, it's all about keeping as much money in your control as possible. And the RSP is a phenomenal way of doing that. As somebody mentions, the RRSP is for US dividend stocks. Yes. However, I want to implicate this as well. There's a lot of US companies you will not pay withholding tax on. And this is where things get really confusing. REITs, always. REITs, whether on any side of the border, you're taxed 15% no matter what off the top. However, if you're buying things like, say, utilities, consumer stapled brands, something like an MO, a Sin stock, let's say, those companies, I don't know how the government looks at them, but they waive the withholding tax. There are a lot of companies that get overlooked because they do waive withholding. For example, this one actually blows my mind because I was really on edge with it, but Algonquin Power. This has been one of my favorite, most recent dividend Canadian stocks, but it's a Canadian company that doesn't really operate in Canada. And this is something that I'm going to talk about because this is where we get really intricate and where things are going to get really confusing. But I promise you, if you learn how to adjust this understanding properly, you're going to make a fortune. Because when you're buying stocks, Canadian stocks in regular brokerage accounts, it doesn't really matter where you're buying it. The Canadian government looks at it as though you are helping the Canadian economy. So Algonquin Power, the reason I was really confused behind the dividend on it was because it's a Canadian company, but it primarily operates more than 50% of its business in the US. Now, where things get a little hesitant here is the Canadian government says, hey, you're investing money in a company that's making money for another country. So we're going to tax you on that. Even above the 15% withholding, you end up paying a premium in tax. Whereas if you're buying, say, something like a RioCan Real Estate Investment Trust REIT that primarily focuses more than 50% of its business within the country, the government literally says, hey, you're helping the Canadian economy grow. We're barely going to tax you. We're hardly going to tax you on any of that. Now, with REIT income specifically, it is taxed a little bit differently, but it is deducted. But the coolest thing that I found out recently, which blows my mind the most, and I actually was just arguing with somebody about this because I had to pull it up from RBC, because luckily RBC actually gives me how they tax corporations. And it turns out if you're running a corporation and you have surplus capital that you want to continue to generate money with, and you're not paying it out to shareholders or employees, and you want it to, do its thing, you can invest it in a Canadian stock. And the Canadian government says, hey, this is a Canadian corporation paying another Canadian corporation. We're going to deduct all that anyways. We're not going to charge you dividend tax because you're just fueling the Canadian economy. When I found that out, I was a little mind blowing because I've maxed out my tax advantaged account, so I can't take advantage of that anymore. So I had to kind of go down this corporate route, which, by the way, like, best thing I ever did, because my business really took off this year. And I mean, I've already flooded like 50 grand through my corporate account. So it's really neat to see how much tax I'm saving doing this and then investing it on top of that through a corporate investment account. So I've realized that I'm still a little hesitant on Algonquin Power because the first thing that blew my mind is there's no withholding tax. So they're not charging withholding tax. However, because it's not primarily operated out of Canada, I am concerned that I'm going to get some kind of different operating tax, especially in a corporation. It might be taxed way differently. But these are a lot of things to consider. And it's unfortunate because it kind of makes you feel like I noticed Graham Stephan talked about this because Graham Stephan is not a fan of dividend stocks. He thinks you should just be buying growth stocks. And I found a really interesting conversation on Millennial Money where he was arguing with Andre Jake because Andre Jake's a big dividend investor and he thinks like it's too complicated to deal with all this tax stuff and setting it all up. But I promise you, if you go through these, it depends on what you want. If you don't need the money today, buy growth stocks. I mean, growth stocks are taxed, and especially in Canada, at a nominal rate on the capital gains. In the US, it's way different because I think you guys in the US are taxed pretty much on all the capital gains, aren't you? Or is there any US viewers in here? Are you guys taxed on all your capital gains? Because in Canada, we only get taxed on 50% of the capital gains. So 50% of any money you make trading stocks 50% of that isn't taxed. You just get it 100% tax free. There you go. Doesn't matter if it's a US company, Canadian company, no withholding tax. You skip all of that doing capital gains. So you can see why it becomes a little more advantageous to be buying capital gain basic companies like your Teslas or your Facebooks because it ends up retaining you more money in the long term. But I also respect in my position, I would rather have some cash flow and I want to get that cash flow at the best tax advantage possible. So I'm playing this little game right now about what do I want to own in my TFSA versus my corporation versus my regular brokerage accounts. And I've kind of stepped up to realize in regular Canadian brokerage accounts, you don't want to own any US dividend stocks ever. No US dividend stocks in regular Canadian brokerage accounts. I can only presume that to be the same on the US side of the border. In your TFSA, that's where you may want a mix of US and Canadian stocks because that's where I'm buying my US REITs, my STAG, my MPW, because I don't mind paying a little bit of tax so long as I'm not paying up half of it in tax. So I'm avoiding the income tax, right? The RRSP, don't really care about as much. I do fuel it up because why not? If you make good money, just put it in there. You're saving yourself a bit in the long term. Use it as a backup retirement plan. And then now I'm kind of taking on this new swarm of a corporate account where I'm learning just way too much. Corporate accounts get very complicated, but I feel like it's giving me a whole new tool set of saving crazy tax income. So that's kind of how the Canadian economy sets it up. And I honestly believe Canada wants you to be rich. Canada does a lot that they don't teach you in school that really helps you avoid paying any real tax and really taking advantage of this boom cycle that Canada is about to experience. You don't pay withholding tax on Canada on British stocks, right? No, I do. I do pay withholding tax on British American tobacco. It's roughly the same. Any kind of foreign income, depending on the tax treaty set up. So I find it kind of interesting that at least British American tobacco has the same tax treaty that we have with the U.S. But yeah, every time I get paid my BTI dividend, I notice that there's a withholding tax that comes up in the transaction. Um, so something on the line of savings accounts or so. Savings accounts, yeah, I don't know what you're trying to reference there. You won't use your RSP to take out 35K toward a down payment. I would never really do that. I know Canada was really pushing people to. So I don't know if this is the same in the US. You can tell me if it is or not. But in Canada, with the RRSP, this account that you're not allowed to touch really until you're 65, you can take a loan. The government will let you take a loan out against it without selling the stocks to buy real estate. However, however, there's implications that come with this because you're taking a loan out against yourself. And though this seems like a great idea because you're not going to be paying income tax or sorry, you're not going to be paying any kind of interest on that loan, you're still going to get slapped with having to pay it back within 5 years. So not only now do you have to pay the interest on the actual property that you bought from the bank getting that mortgage, but now you have to pay back within 5 years what you borrowed from your RSP. So now you have to double up that loan. So it's kind of annoying because yeah, you're borrowing against yourself, but now your down payment is technically a loan that you have to fast track. So you actually have to pay a lot more back a lot quicker. And it's really stupid. I feel like it burdens more Canadians than it probably benefits them. But then again, in the real estate market we're in, when you when real estate's doubling and in a few years, I mean, yeah, it's probably worth it, but that's kind of unpredictable, right? I thought you read our tax treaty. You guys didn't pay. Must be the same as with US. Yeah, the I don't know. I just noticed that British American Tobacco I definitely pay some kind of tax on. Why buy dividend stocks in an RSP at all? You're young. You can touch those funds. Yeah. So here's the thing. This is the interesting dilemma. The way I've set up my accounts is I want my tax advantaged accounts to be for dividends, primarily always for dividends. My TFSA, 100%, every company I own in there will pay me a dividend. I will not own a growth stock anymore in those accounts. Why do I do this? Well, because by the time, let's say, when I reach 65, do you know what 30 years of compounded growth from a company like J&J with those dividend increases could look like? I mean, you're talking about companies that double their dividends like every 10 years almost. So, I mean, you skip out 30 years and your yield could really start looking like 15, 20 plus percent. And I'm already experiencing some really high dividend growth on things like Southern Company, Apple, companies that I've owned from the beginning. Like I'm already capping in over right around a 6% yield on something like a Southern Company because I've held it for so long. And I mean, people have to understand that, yeah, we're in a good growth cycle right now, but typically over the long term, dividend aristocrats will outperform the market. And that's only because not only are they compounding the dividend growth, but you're reinvesting those dividends. And those reinvested dividends also give you compounded growth. And it really packs in over a 30-year period, right? So the only place that I'm owning my growth stocks is in my corporation, because the whole point of my corporation is to sustain as much of my income without paying tax as possible. So yeah, don't get me wrong. I get grilled on this all the time because people are like, yeah, but you can't really own that money. You can't put that money in your personal name. And if you ever liquidate your business, you're going to get slapped with crazy taxes. And yeah, that's true. So why the hell would I ever liquidate my business? I'm going to leave all that money in my business forever. If I go on a trip, hey, it's a write off. I'm going to be doing TikToks, talking about stocks. Everything I do is a write off, and that business is going to be paying for it. So why not try and avoid paying as much tax up front as possible, which, by the way, the Canadian corporate tax rate is like 3%. So every 100 grand I make, I'm paying what, 3,000, 5,000 at the most on income tax. And then you put that into a growth stock like Facebook, like Google, and maybe they continue to compound at a 30%, 20% rate of growth. And you're like, holy crap, like this really conspires quick. And then you look at the fact that on capital gain tax for a corporation is like nothing. Dividend income from Canadian companies is like nothing, literally nothing. And you start realizing how corporations get absurdly rich. In Canada and in the US for that matter. I mean, the US, depending on what state you're in, your corporate tax is different. And that's the same in Canada. Different provinces have different corporate tax rates. Um, it's a fascinating thing. It's a fascinating thing for sure. But yeah, this is kind of how I've divvied it up, right? Because I like dividend income, and I'm going to use that as a backup reserve fund for me. So if I need money tomorrow, I have access to it. However, if I have dividend companies in my corporation, I don't want to pull those dividends out. I want to avoid that because I'm going to pay myself a salary. The way I've discussed this with my accountant was the idea is if you can live on a really low income, let's say 30, 40,000 a year, and you're able to make say 100,000 a year, you're going to pay yourself that salary from the corporation. So I will be paying, and this is where you kind of get screwed a little bit as well, is I have to pay the 3% corporate tax rate. And then when I pull that money out into my personal name, I have to pay my marginal income tax, which could be, 20, 30%. But if, again, quick example, if you have 100,000 that you're making in a corporation, you pay yourself 40. If you were to pay yourself that 100 grand up front, you would be paying about $36,000 in taxes or so, something like, no, sorry, I might be over calculating that. I think it might be around 28 to 30,000. Whereas in the corporation, if you pay yourself, say, a 30 or $40,000 salary, retain 60,000, you're only going to pay 13,000 in taxes. And I know this is really confusing without me like having a whiteboard to kind of explain this a little bit more in depthly, but it's kind of staggering. It's kind of staggering the amount of capital you can retain. And I'm going to tell you, this is something that you're just going to want to do a lot of self homework on, because taxes are the number one thing that I think withholds so many people back from really taking advantage of wealth building, because they just don't understand taxes. Hell, I didn't understand what a TFSA was 3 years into investing. I didn't know what it was. It took me 3 years to figure it out. I'm an idiot. Idiot. Man, I feel so stupid that I didn't look into that or nobody pointed me in that direction. Um, How do you long term in life pull large amounts out of a corporation? You don't. You wouldn't. You just use it to pay for things. That's what people don't understand, right? Like everything in your life is technically a write off to your business, or the vast majority of it. Probably 30% of your food is a write off. Your car is definitely majority of it a write off. If you get on a plane, especially in my business, is a write off because I can take videos of everywhere I go. I can make YouTube videos about it, right? So you start realizing that you just want to use your corporation. And let me explain to you what a write off is for those of you that don't fully understand that concept. If you're living your normal life, you're working for a job, you're paying your 30% tax rate. Now you've made that money. So now that you take that money, you're like, I want a car, I want an iPhone. You're going to go now pay that iPhone after paying 30% tax on that income. And now you're paying HST on that car or that iPhone that you bought. You're paying all this extra tax on top of that, and you're buying this car at this huge premium. Whereas in the corporation, you're paying no real income tax, and then you're buying that car in the corporate title. So you're skipping 30% right off the top. You're retaining 30%, you're buying that car, and then those taxes that you're paying, you can actually get that money back. So all like the HST tax or like any tax you're paying on your iPhone, technically you can write that off and get most of it back, which is hilarious. That's the joys of a corporation, right? You just end up retaining so much more money using daily things in your life, which is why I always tell people to start a side hustle, because even if your side hustle, let's say, is only making 5,000 a year, it still doesn't matter because you can take your main primary income, source it into your business, because that's what I did, right? Like I took a lot of my income that I already had and I fronted my corporation $20,000. So I'm literally donating my money to the corporate account, but now I can invest with it and do things in a tax advantaged way. And the government will deduct that from my personal income because I'm fronting money to keep the corporation going. And like I said, it's just really interesting because then you can write yourself down into different income tax brackets, right? So let's say you made 100,000 in a corporation, and or like it's just there's so many ways to think about this, right? Because let's say you're in a high income bracket. Well, if you need to pay for a car, a phone, food, all this stuff that could be looked at through the corporation, you can write yourself down into a lower tax bracket because all that stuff brings your tax income down. Like I don't know how to explain this, and you really need to sit down with an accountant. This becomes jargon when I'm trying to spew it out because I know it's hard to make sense of, but trust me, there's a lot of reality in what I'm saying. I guess write-offs are one of the ways in how the rich stay rich, 100%. Because just in the simplest terms of what I just said, right? Like if you're paying 30% on tax and then you go and buy a car and you can't retain any of the tax you're paying on top of what you paid for that car, it's tax on tax on tax. It's ridiculous. But in a corporation, there's no income tax. You buy a car, you can write the tax off and get some of it back. Like it's so funny how, like I said, Canada wants you to be rich. They just don't tell you this, right? Like unless you're like you got a good lawyer and accountant, it's really complicated. But who knows? I plan on making a course about this very soon. I'm going to sit down for an hour and try and focus on Canadian related content because I realize that a lot of my viewers are Canadians. They have no idea what the hell I'm talking about. I barely know what I'm talking about. I'm learning one step as I go, but now I'm several years deep running a self-employed business, and I think I've learned enough that could really help some other people come up and really kind of help them retain some of their capital, because that's the whole goal. It's always about retaining as much as humanly possible. It's 15 years now for okay. So David is telling me that it's 15 years for returning. I guess you're talking about the repayment on the RRSP if you're using it to buy a house. Even still, that's not too bad. That might not be as bad. Kyle for the win. Yeah, it's I don't want to say Kyle for the win yet. I'm still living at home with my parents. I'll say I'm winning when I've got a nice place and whatever else. But I don't. This is probably the first time in my life I don't feel broke, because I've never made this much money and I've never understood anything like this before. So, how the rich preserve their wealth. Yeah. So, I mean, I find it kind of interesting because my tax rate last year on my income was about, what did I pay, 14 or 15,000. This year I'll pay roughly the same, but I'm going to make about double the money. I run a successful side hustle, but my accountant told me filing taxes for a corporation cost a fortune and isn't worth it. That's not true. So I said again, when you look at how much you're going to save, is it worth paying more to have an accountant file the taxes? And I got to say, it is for me. It is for me. My accountant told me that I could save myself about 15,000 to 17,000 on every 100K I make through a corporation. Those corporate filings cost me about $900 to do a year, and the corporation cost me $1,000 roughly to set up. So for the first year, me running my corporation, I'm paying an extra, what, 2,000 up front to file the taxes and incorporate. Whoop-de-doo if that saves me $10,000, $20,000. Yeah, I'll front 20% of that if it's gonna put an extra 10K, 8K in my pocket. Who cares? Get married and max your wife's TFSA. That's not a problem. My girlfriend's very fortunate. She knows what she's doing. I don't need to get married. She'll be fine even without me. She knows what's going on. She's smart. She'll be well endowed on her own. What else we got going on? But what are the requirements of owning a corporate account? Is there requirements of how much you have to earn? No, you can open a corporation earning nothing. It's just a matter of it's not worth it if you're not earning anything, because you still have to pay yourself. Like if you work, okay, let me put this in example. Like let's say you work for a business, you're not self-employed. If you start a side hustle and that side hustle only makes $5,000, it's still worth incorporating because you're going to save so much on the write-offs, and you're going to be able to take your own working income and deduct some of your bracket. So you'll end up paying less tax. You'll probably get taxed back. I know this is too much jargon. I know it's a lot of jargon, guys, but it's not worth opening a corporation if you're self-employed only. See, I'm 100% self-employed. So if I'm only making 20 or 30,000 a year, it ain't going to be worth opening a corporation. I'll be paying too much in fees. I won't be able to afford to live. But if you start making surplus income, you start getting in that 60, 70, 100, 150K bracket of income, you'll start realizing the crazy amounts of money you can save. Can you start a TFSA in your company with max room in the name? No, you can't. You cannot put a TFSA in a corporate account. TFSA is personally linked to your name. As a Canadian, you only get one TFSA and one RRSP. However, I do own a US and a Canadian investment account in my corporation, which I feel so brilliant. There's nothing, I find it so cool that my income is completely divided by two currencies. I make half my money in US and half my money in Canadian income. There's something so like interesting about that to me, that I can just do that in Canada, that I could just, operate out of two different countries without having any citizenship at all, and, really diversify that income. I really recommend that on any side of the border, you want to diversify your currencies a little bit. So I always recommend owning, even if it's just a couple Canadian companies, because I really believe the Canadian economy is way too overlooked, and our dividend companies are so resilient. Like we have some of the greatest dividend companies in the world, even compared to US companies. I mean, banks, just look at our banks. Our banks did not cut dividends in the pandemic. Canadian Imperial Bank increased the dividend going into the pandemic. And the stocks are at all-time highs. I mean, they just did so much better than the US banks in this crisis. You have to be careful being categorized as personal service corporation, though. Your tax would be very high. No, see, it's how you file your corporation, because I incorporated. There's a lot of different files of incorporation, and I can't even remember what they are. I When you're claiming a title, to the government, you have to claim a title. My title is Passive Income Investor Inc. If I had my wallet, it's over there. I could show you, because all my bank statements. So look, I'm the director and the CEO, and I am the only shareholder in my corporation of Passive Income Investor Inc. It is a separate entity from me. So how you class that entity will debate on how it gets taxed as well, because I've been self-employed forever and I've never been incorporated, though. I get some tax benefits being self-employed, but I never did the files of incorporation. It's a whole different ballgame for how you're going to get taxed. Is there a reason you're not using Questrade? Yeah, this is frustrating to me, because yeah, I started investing several years back with Scotiabank. All my money, all my TFSA, all of it's with Scotiabank. My accounts are so big and I'm investing so much at this point. I don't mind paying a 10% commission, because my minimum trades are always above like $1,000. So who cares if I have to pay $10 on a commission to trade $1,000 into a company? I know it sucks, because Questrade, I think, charges like $5 or less than that a trade, and Wealth Simple is 100% free. That's your gift. That's the gift of, getting in the game now and knowing these things. Because when I got in the game, I didn't know that. I didn't know anything about Questrade. So I'm stuck with Royal Bank, Canadian Imperial Bank. And yes, I pay them a lot of money in fees, and I'm not a fan of it, but it is what it is. And I've done the best that I can with them to pay the least amount of fees as possible. And I like them. I honestly like Scotiabank. I don't like their online trading platform because they never answer the phone. That's why I'm using Royal Bank, because Royal Bank gives me more money. Scotiabank is stingy. They're the stingiest bank, and yet they have like one of the best online trading platforms. Man, they're so stingy. They won't give me credit. I have to fight tooth and nail with those people. They gave me what, like a $10,000 line of credit and a $2,000 credit card. You know how dumb that is? It's nothing. That's for a guy that's sitting on $300,000 in assets. That's all they'll give me. You know how annoying that is? Royal Bank, I knocked on the door and I'm like, hey guys, this is what Scotiabank did. I would just want more money. And they're like, hey, here's 20 grand. Here, you want 20 grand? Here you go. Oh, you want to open up a corporation account? We're great with corporate accounts. This is all we do. Like, I like Quest Trade, but there's nothing worse than how buggy their apps are. That's the thing, right? Scotiabank, by far, I'm going to put it next to TD. My two favorite trading platforms in Canada. I hate Wealthsimple. I've used it. I don't like the way the whole platform operates. It's kind of like a third-party bank. It's kind of like a pretend bank where you can't even like pull the money out in a savings account. You actually have to retransfer it back to your regular bank. So it's like this weird third party thing that has all these different, like you got to click through all this different stuff. It's really, especially with crypto, it gets really intricately like complicated for some reason. Same with apparently with Quest Trade is it's buggy. Scotiabank always works for me. I never have issues with it. Same with Royal Bank. I don't like Royal Bank. I would pick Scotia and then TD. Scotia and TD, they calculate dividends really interestingly. Believe it or not, Royal Bank doesn't show you your projected dividend income. Really frustrating. Scotia does a great job of that, and TD does. I like them both equally. I don't use TD though. I wish I set my corporate account up with TD. I would have been a little happier with the layout. Dealing with Quest Trade during tax season is a pain. Don't even tell me about it. Oh my God. Don't even tell me about taxes. I calculate them every month. Yeah, actually, you want to know how you avoid paying a lot of tax? I should have mentioned this prior. If you do not do your own income and expenses, your taxes are going to be insane. My yearly taxes are so cheap because I do all the work. My accountant doesn't do any work. I hand him the work. I say, here's my entire year's worth of income and expenses. He just takes those numbers, do the deductions, figures out where there's some loopholes. That's it. And then I pay him $1,000. If I didn't do that, I'd be paying him thousands more. I can tell you that because it takes me hours. Like I have to sit down at the end of every month at least for a couple hours to do my income and expenses. TD is TD. All the banks. I'm really curious. Are any of you using Canadian Imperial Bank? I have never used their trading platform, and they just recently introduced fractional share buying on the CDC market, which I find very interesting. Where would you buy an S&P 500 index, RRSP or TFSA? Would you personally pick some stocks? Yeah, this depends on personal preference. If your personal preference is that you're not trying to fast track retirement, I would just own index funds in all those accounts. But personally, I use my TFSA as a dividend income only account, and I use my RSP as I don't care about it. I own three individual stocks. I should own, if I was smart, and maybe I will soon, maybe like a QQQM. I really like QQQM. I maybe buy into the VOO or the VTI. I might do that more into my 30s. I'm living on the edge, this interesting edge of when do I start buying index funds? Haven't been able to do it yet. Every time I do it, I sell them. Always sell them. I don't know. I just indexes are so boring to me. Like I just like if most of what is driving the index is the top 10 holdings, and those top 10 holdings are Apple, Microsoft, Facebook, Google, Amazon, Tesla, PayPal, Johnson and Johnson, whatever. I mean, why not just own them? You want to know how much those companies move the index? I mean, just look at Berkshire Hathaway. Isn't it so funny how Berkshire Hathaway sits in like the top 10 largest companies in the world? And it's primarily just because they own large percentages of the largest companies like Apple in the world. I always find that so funny. It's just like if Buffett can do it, why own the index? Why pay a fee when you can just own the top 10? And yeah, you might have to trade them. I mean, they're not going to be perfect. Some things might fall out of favor, but I think if you pay attention, the adjustments aren't that hard. You could literally just copy them. Like just copy them. Just the S&P, the VOO just moved a weighting. I'm going to deduct that weighting and make them equal, but I'll run it as though it's my own index. Can you comment on CDRs? Yeah, I haven't done enough homework just yet. I'm kind of curious about it, to be honest. I didn't realize how much Canadian Imperial Bank is moving the needle ahead for the Canadian investment accounts. Canadian National Railway and Apple are these worth adding into these days? I personally do not like CN Rail. Let me take a look at it right now, actually. It's a good question. I like Apple here. To be honest, when we were going into this earnings season, I would not have touched any of these tech stocks. I was with the highest degree of certainty so sure that things were so overbought and things were so outlandishly like just exaggerated because of the pandemic. Like, who the hell is buying iPhones and MacBooks? Has not everybody already bought those in the pandemic? Has not everybody already used Facebook and Google enough during the pandemic? We're all going out again. So I was expecting a decline. Now, however, we did see that with Amazon. Amazon saw a bit of a decline. Facebook lowered its guidance. Not that it matters. I mean, we're still talking huge numbers, but honestly, after this earnings, I threw money into Google. I didn't even question it. I was just like, okay, these companies are still astronomically growing at a pace that I think too many people are sleeping on, and it's unappreciated. CN Rail, what stops me from buying that is the massive premium and my problem with the fact that electric vehicles are going to be the cheapest way of transport in the future. Now, let me kind of reiterate some stuff here because that might be a confusing statement. What people don't understand right now is railways are the cheapest way of transporting goods, and it is also contractually only allowed to transport highly toxic goods. Let's say, like if you're moving a lot of chemicals around, you're not going to be doing it by truck. It's just way too deadly to have heavy chemicals on trucks on highways that could have accidents that could, like, I mean, oil alone and just trucking that stuff is extremely toxic. And I'm sure you've heard of accidents that take years to clean up. And even still after decades, they haven't been able to fully solve those problems, right? So trains solve that problem and they are the cheapest way to transport those goods. But since the invention or the advancements in electric vehicles, Teslas, all these transport trucks, it's actually going to become cheaper to use that over a train. And I'm still curious to how, in the near term, like say the next 3 to 5 years, as those things become implemented, what it does to something like a CN rail, or if it's something that changes. I don't know, because electric vehicles don't do that well long range either. So I'm curious to if the timing has something to do with it. Like you have to stop and charge now, whereas the train still keeps trucking along. I don't know. CN Rail, though, is trading at a 24 PE. The dividend yield is 1.8%. It's almost a $100 billion market cap. And let's just take a look at the growth rate. Is it CN still doing a good growth rate? This would probably be a good company to own in an RRSP or a tax advantaged account if you have a long term time horizon. But let me just take a look, because is it still growing at the rate? Come on, let's take a look here. Where are we? Let's go. Come on. Why is it not loading? Give it a sec here. Let me switch to my LTE. This is really frustrating. There we go. No, actually, yeah. So in 2020, which is another problem, this is a scary thing for me, because this is like RioCan all over again. I do not like seeing companies that declined in the pandemic. If you want the most robust portfolio you've ever had, buy companies that excelled during the pandemic. Your Cloroxes, your Googles, just those are the companies that are going to lead the way. Unfortunately, CN Rail saw what is that? Maybe like what is that? Maybe like a 10% decline in revenue growth. EPS fell off a cliff. Quarter over quarter, it's nominal. It doesn't look like they're experiencing any kind of extreme growth. So not that appealing to me, to be honest. It's kind of slow growth. Kyle, where did you see the CIBC introducing fractional shares? I can't seem to find anything news on it. Yeah, so just take a look. Just search up CIBC, and you should be able to just look up the CDR market. So if I do CIBC CDR, what comes up? Yeah, CIBC, where is it? Canadian Imperial Bank. Yeah, so just look at this one. This is the article you want to look at. So it's called, oh my God, sorry, I'm stuttering here. This is an article that's actually on the CIBC website, and I would take a look at this. It's called Canadian Depository Receipts, the CDR. Buy U.S. stocks in Canadian dollars. And they also go on about, or is it fractional shares? Am I messing this up? Yeah, let's put that aside. I don't want to start jumbling the stream up. They're doing fractional shares, so they did introduce it, I'm pretty sure, unless I really skipped the butt on that. Still love RioCan, but I was way too weighted in dividends. Yeah, I think I started a spark of sell RioCan, and this was not intentional. I mean, RioCan made up 12% of my entire portfolio weighting, which is extreme. At my age, it doesn't matter. In my opinion, I think I can afford to take on maybe even a little more risk than I am. However, RioCan in my TFSA were the first shares that I bought, and I paid $22 for them. I was getting like a 5.5 or 6% yield at the time, and I was happy with that. But then the crash came. Okay. And this was in the middle of me adding to the position, by the way. It wasn't like that was my total position yet. I was still scaling into it. So RioCan drops to $15 a share. I don't have any money in my TFSA really to add to RioCan. So what I did was I started buying it in my regular brokerage account because the yield was crazy, right? Like it hit 9% when it was at the $14, $15 range. So gobble that up, gobble that up. I was just buying, 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 buying. So through most of the year, we collected a 9% dividend yield, which they cut at the beginning of this year. And what I realized as RioCan recovered in my TFSA, when they did the dividend cut, my yield went from like 5.5 to 6% down to about 4.3%, 4.5%, because it was a 33% cut. So when I looked at that yield and I looked at the fact that I was just getting green again, like I think RioCan was at 22.50, $23 a share. And I was like, holy crap. I'm like, I could literally sell RioCan in this account. I could transfer it over into, say, something like an Algonquin Power or a Medical Properties Trust, and my dividend would actually be slightly higher, and it would help diversify me away from owning so much RioCan. And it just made sense because I'm like, I'm not losing money on the position anymore. I've made money on the dividend return, and it just seemed like an appropriate thing to do. Yeah, I just made that decision in like 2 seconds. I just looked at it one day and I was like, damn, I should sell this. It would just be wise. And I also didn't realize, but like RioCan was making up a huge, huge percentage of my overall dividend income, which to me was also a little sketchy because right now it makes up 12% of my annual dividend income, which is a lot. Before I sold it, it was probably closer to like what, an 18 or 20% of my annual income before the 30% cut. So that's a lot of money. That's too uneasing for me. So I think MPW will nicely diversify my dividend income from my REITs. I love MPW. Oh God, Stag Industrial and MPW. God, I could roll around on the floor about those companies all day. They're just the management that set those companies. Like, could you ever build a self real estate portfolio that is so diverse and so well encored by the biggest companies in the world than say something with a Stag? I just can't. That's why it's up so much. I mean, when you can recognize what a real balance sheet, like a real good balance sheet looks like, it's crazy to see what happens when it dips and you buy it and then people recognize it for what it is and then it goes up like 30 or 40%. I've made so much money on Stag already. Who says you can't make money on REITs and dividend stocks as fast as you can with growth stocks? I think if you just find the right opportunities and you take advantage of them when they're down, you can make crazy good returns. I might have misunderstood the read the news. I had understood that CIBC was offering that product. Like BMO operates some ETFs. Yeah, for someone that has no interest in investing in real estate, I'm from Vancouver. Do you suggest investing a down payment? Yeah. So personally, this is the question, right? I always find that if you own real estate, you might not want to own a lot of REITs because you might be overexposing yourself to the real estate market, and especially if you're in Canada and you own a piece of real estate and then you buy Canadian REITs, you're really over leveraging yourself. So yeah, I that's what I did. I mean, I've got easy a down payment on a house in real estate. I mean, I've got what? I've got I can't even do the math in my head, but it's a lot. Like it's probably around 50 grand, I would think, just in REITs alone. Within reason, obviously. I know I got an interesting debate for you guys. This is a really interesting debate. And I think it's really projected depending on your risk profile, your age, et cetera, et cetera. But I had a little bit of a discussion with a buddy of ours in our chat group because he wants to sell all of his growth stocks and he purely wants to buy for income. He's looking at things like your QYLDs, your all of your REIT income, Canoe. There's a fund called Canoe something, and all of these things are paying like 10% yields, and you're not getting any real capital growth at all out of these things. You're not really getting a compounded dividend growth rate, but what you are getting is a fat stack of cash every month. And we had this really interesting argument or debate about, what ends up getting you farther ahead. Because to me, total return matters. Total return absolutely matters because if you're not really utilizing that capital today, I mean, you just missed out on Google going up 50%. That's like the safest investment, one of the safest companies, the highest rated companies in the world, and it's growing at the pace of a penny stock. So, like, you're giving up that for an immediate amount of dividend income. So, let's say you invested 100 grand into one of these 10% yielding ETFs, and you invested 100 grand into Google at the beginning of the year. So those ETFs are still flat, but you would have collected at this point in the year about $5,000, let's say. If you bought Google, you would be up $50,000 already. So that's like the way I look at some of these high yielding companies. But then you have to take into consideration, we go into time periods where growth stocks will not grow. There will come a time where Google may flatline or go down for a couple years. I mean, Amazon's done it. All these growth companies to some degree have done it. And in those moments, especially in the pandemic, like we just experienced, those those high income producing ETFs and REITs really outperform, because now you're getting a lot of capital up front that you can reinvest in the crash. So now you're doubling down in the moments of crashes. And that also will perpetuate much faster over the long term. Because as I said, would say something like your dividend aristocrats, over time, that's so much money that you're getting to reinvest that your dividends naturally go up at an exponential rate. So it'd be really neat to run some kind of a fundamental analysis over a 30-year period and project out what would give you necessarily a good return. Because it's really hard to debate this, because obviously if you're collecting a 10% yield and we go into a crash and a lot of these ETFs never cut their dividend and you invested into a lot of dividend stocks at the bottom, I mean, you'd be up 50, 100% on a lot of those dividend companies, a lot of those ETFs. Your yield would be exceptionally much higher. And I don't know. It's an interesting thing to try and understand, because I'm always trying to find a balance of dividends and growth. But I always believe total return matters the most. And I don't think people should be overly blinded just by yield, though it should be a good part of your portfolio. Because for me, being self-employed, I like the backup income. But that's the debate, right? Like, I mean, it's a hard debate because it really comes down to what happens year over year and how you're implementing that cash flow. Um, I need to find another job when I'm working and bored, maybe Uber Eats or something. So I would do Uber Eats in a heartbeat. If I didn't have so much money coming in from my business and I had extra time, I'd probably be still doing magic. I mean, I quit my full time career as a performer, which was really smart. To be honest, don't take a career in the art and entertainment industry. It was the best time of my life, but it was also, for an income perspective, the stupidest thing I could have ever done. Because I could have been much farther ahead right now, but I didn't know any of this when I started my career, and I had fun. Don't get me wrong. I got to do stuff I think people wish they could have done, especially considering I was doing it every weekend of my life for a decade. And I was able to save enough to get me to the level I'm at, but that's also primarily in part due to my parents. I live at home. My parents definitely, obviously, contribute to my savings rate. Um, but yeah, finding a side hustle that makes real money is a challenge, because if you say take on Uber, you're not going to be self-employed. You're well, actually, does Uber count you as a self-employed person? That's an interesting question. To be honest, if you're bored at work, I would recommend learning how to build websites. I would recommend learning how to code, learn Google's AI. Right now, Google's machine learning program doesn't require any coding, and they have a 3-day crash course on how to use it. Probably the most useful tool you'll ever learn. Websites, that social media. If you know how to leverage social media, I would focus on those before I would do Uber Eats. Because yeah, Uber Eats might pay you a bit of capital up front, and it doesn't take a whole lot of education, but it's not nearly as impactful as social media is on income right now. And again, take this into perspective, guys. I started YouTube 3 years ago. I didn't make any money on the first year. The second year, I think I made like 10 grand. This year, I'm going to make six figures. So within 3 years of me starting social media and websites, I'm already making six figures. And if you look at the statistics on Amazon, the average Amazon reseller right now makes over 100,000 a year. And that's crazy. That's the average. So if the average person on Amazon is doing six figures in revenue, it might be a good idea to figure out what those people are doing, because you're the average person. And if the average person can do that, so can you. And then you can start a corporation. You can exceptionally save on tax dollars and do write-offs. So I would only do Uber if you can't really push yourself on some of these other fronts of just where business is going. It's just where business is like. I'll give you a quick example. This is how useful my skills are. It blows my mind. My skills right now, I could sales pitch one out of three people, because one out of three people are trying to start a side hustle and have no idea what they're doing. And just to give you an idea, because I'm so enthralled in the world of building businesses that you can flip online, I just built this website out of the kindness of my soul, because I like helping friends out. You can take a look at it. It's called hype6plug.com. These are girls that are doing six figures in revenue off reselling shoes. If you like Jordans, if you're into your Nikes, I got a hookup. I completely built this website for them. It's an awesome website. I really love it. It's all connected to Google Analytics, the whole 9 yards. And they had a really good website. I just feel like they didn't understand like how you structure a website to make it sellable, because it's not just about building a website or a business. It's about understanding, like, can you sell this business? If you scale it up to 6 figures in revenue, can you flip it? Because if you can sell your business, you're going to make a fortune. But unfortunately, it requires a year of at least Google Analytics. No one will ever buy your business if it doesn't have a year's worth of Google Analytics. So even if you've done your online business for a year and you never hooked it to Google Analytics, no one's going to look at you. No one cares. I know this world inside and out, and I don't know why I feel for the first time super cocky about my knowledge, just because I can do this stuff at a really quick rate, faster than most people I know that do it professionally, and I can do it for nothing. Literally nothing. Do you know what this website costs? This website's going to do 6 figures in revenue. It cost me less than $100 to build. Yet so many people want to go out there and they want to open a retail store. Like, it's 2021. Who the hell is doing retail when like, think of it this way. If you take your retail store, build an online store, it's going to cost you $40 a month, $100 to start the stupid thing. You can take all of that money, the rent, the $2,000 a month you're spending on rent for your store, and put it into marketing. This is a whole nother level of income. That's what we do. I can show you how to do Facebook marketing, Google marketing, TikTok marketing. I make money on all of these platforms utilizing all of their ad campaigns, and it works. It just works. And no one does it. Nobody does it at all. It blows my mind. Okay, so look, me and Matt, my business partner, like, the day we realized how to use Google Ads, how many people use YouTube and don't know how to use Google Ads? Do you know why Google makes so much money? Because it's Google Ads and nobody even knows how to use it. But when you figure it out, you'll be rich. You'll be rich. There's no way else to say it. When you know how to utilize the tools of tomorrow, that when every business and their grandmother is trying to figure out right now, and you know it better than they do, they're going to leverage you. Because my income from the time I didn't know how to use those things till now is insane. I would not be making 6 figures if it wasn't for knowing how to use Google Ads, TikTok, Facebook ads. Like, I would be nowhere. I would be nowhere near close to the level of income I'm at. Very, very useful tools. Great video. I'm an American, and a terrific explanation. Thank you. Take care. Stay safe. God bless. Thanks. Yeah, I'm not trying to be cocky or like too forthgoing or jamming this stuff down your throat, but like, these are just really useful things that are not that hard to learn. You don't need to go to college to get an education. It's all on YouTube for free to learn. And like I said, it doesn't happen overnight. I've been doing websites and YouTube for years now, and I've only just figured out how to make money at it because I understand business. I think one more thing I want to say, and I'll finish up because it's mostly a tax Canadian video, is I find people are very stingent about helping other people when they're self-employed. They're too good to help people. What do I mean by this? Well, people need to be serviced in some way, not in that way, obviously, but maybe to some degree. If you're on OnlyFans, they do. And hey, that's a business in and of itself. OnlyFans is a big income driver for a lot of people. But when you're marketing your skills, you're not going to be marketing them to things you want to do. If I could do things the way I want to do it, I would just be making my own videos out in a huge studio and spending all this money and having a great time making content that I love making. But that's not the 6-figure business for me. The 6-figure business for me is leveraging my skills to help corporations and companies and stocks. So as you'll see on Monday, I got a bunch of sponsors this week. I know a lot of my audience might not be as fond of some of these sponsored videos. I love them. I think it's incredible to get paid to learn these companies and actually talk to the CEOs and get on the board of directors. Like, it's mind blowing to me, because I'm leveraging the content in ads and I'm pushing campaigns across multiple platforms. So that leverage is extraordinarily valuable to my clients, and they're willing to pay a huge sum of money for that value. But what most people will not do, especially my business, that I find, is they're too good for that. They think it's too slimy to promote a company, even though every company has an advertising budget that's in the millions of dollars, by the way. And when I look at these balance sheets, where I go right away first, which nobody does. As a self-employed person, when I'm working for a company, the first thing I do is I scroll through their balance sheet on that CEDAR filing, and I take a look at their marketing expenses. If this is a company that is spending $1 million on marketing a year, it's a company I want to work for because they're going to be spending it on me. And it's such an easy way to find work. I mean, guys, if you know what the companies are spending their money on and you know what they need and you can supply it to them, go email them, call them up. It's a great, it works. It really does work. But if you don't know what you're doing and you're not trying to service other people and you're just trying to service yourself and you're too good for that, then don't expect to make money. 90% of YouTubers will fail. And I said this from day one when I started YouTube. I'm not going to be the best. I am not the best. I'm just going to outlast everybody. And you know how many YouTubers have already come and gone since I started this channel, and now I'm in this really awesome range of income with hardly any audience. By the way, I mean my audience is like 10,000 subscribers, but I'm able to reach a lot more because I understand ads and Reddit and StockTwits and these other platforms that are highly advantageous to companies. They're very, very useful skills to learn, and it's kind of nice that I've managed to build all of these up over time. But yeah, so it's fascinating, man. It's a fascinating world we live in for sure. But take advantage, guys. If you get bored, take a website course. You don't have to know how to code anymore. You can start your company doing this stuff. You can go find people that need help. I would avoid small business. Always avoid small business. Don't even waste your time. If they don't have $1 million budget, they're not worth your time because they're not going to spend any money on you. That's a mistake that I made being a magician. Being a magician is not a well leveraged tool. It was great for tax advantages, but how much value does a magician provide to society? I mean, a company needs investors. I can give them access to investors and tell their story. That's insurmountably valuable because one right retail investor might have 500,000 to invest in that company they're interested in. A magician is only here to entertain the kids. And I'm telling you, it's so funny because I've gotten so much more stingent with my time. I got a job offering for to teach an 11-year-old some magic. And I still like to do this stuff. I mean, I like giving back. I'll do some of this stuff, but at a rate, right? So I charged them $300 and they laughed me out of the room. I couldn't get over that. I just couldn't get over it. I was like, I have to drive an hour. It's going to be 2.5 hours there and back. I have to sit down with your kid for 2 hours. I had to learn magic for a decade. I had to buy thousands of dollars worth of material. $300 is reasonable, but that's not the value proposition. There's no value in that to people, right? And I mean, when you go look at YouTubers too, you'll see how they lean into their value. Like look at Unbox Therapy. Unbox Therapy promotes the crap out of affiliate links. He makes a lot of money off affiliates. Another magician, a big YouTuber, Chris Ramsey, actually made fun of me once. It was really funny because I was kind of a stereotypical magician, but he makes all of his money off affiliates through puzzles. He doesn't even do magic. He just does puzzle reviews because there's so much money in offering that value to society that people that are interested in puzzles. It's really interesting. So anyways, it's getting into an hour here. I'll do 5 more minutes, questions and Q&As. If you guys have any questions about Canadian dividend stocks, leveraging tax, let me know real quick right now before I bugger off. So let's see, Kyle, I'd like to see a few secs of magic. Here, I'll show you a quick trick. This is really dumb. Maybe if you guys come to Vegas, when we go to Vegas, the 23rd of January, and maybe when we do our meetup in Canada, which will be soon, I'll announce some meetups. I'll do some shows for you guys because I have a full hour set. Like I have a full on hour show on the history of magic. My show, I loved my show, by the way. My show was good. I wouldn't say it was great, but it was definitely try not to stroke my own ego here. I put a decade into it and I had some incredible clients. I mean, I was working for the Royal Bank. I mean, I was introducing the CEO at the annual meetings that they did to do like awards raises. I actually got to introduce CEO of the Royal Bank, the largest bank in Canada. I was super cool. I got to work for the government. I literally got to work for every single or rub shoulders with every single person that deals with your tax dollars in Canada. We got to work with the tax company as promoting team because this tax company would go to these, what do they call them? When everyone sets up a booth and you all have to kind of promote your products to clients that come to these trade shows. And we got hired by a tax company to entertain people, to bring them to the booth. God, that was fun. That was fun. They paid for our rooms, our drinks. They paid us a really healthy paycheck. And I got to rub shoulders with every single person in Canada that deals with our tax dollars. And I have stories. That's a whole video for another day. But my God, do I have stories. Lots and lots of stories. Shit that I probably shouldn't repeat, because I heard how people ripped off municipalities, got away with six figures and theft, a lot of cool stuff, interesting stuff. But those are stories for another day. God, I that was the only thing fun about my career, was traveling and just meeting these people and actually, having success and luck, a lot of luck. Looks like great. Okay, what else? Last few questions. Can we just talk AMC stock? I wouldn't buy it. I hope this guy sold it. I tried to, so look, people got greedy real quick. With AMC, GME, they went flying through the roof. And when AMC was, I actually called the top. I called the top of AMC. I actually made a video. I don't know what video it was. You could probably go find it. But when AMC hit about a $30 billion, $40 billion market cap, I said it was time to get out. No more AMC. I could be wrong in the long term, but when you take a look at the chart, it peaked out at about a $30 billion market cap. The same thing GME did. And then GME massively sold off afterwards. And I know a guy that was kind of gambling on AMC, and it went up a lot for him, and he was sitting up on a massive capital gain. And it blew my mind that he wasn't taking profit. So I tried to lean him in the direction. I'm like, man, take profit. Like, this is the time to take profit. Heck, it doesn't hurt to pull 30% off the table here. And I'm hoping he did it, because it dropped pretty substantially after that. And that was literally the top of the market. Where's GME at right now? Yeah, GME is at 11 billion. Like, it is time to take profit on these things, because guys, when the companies themselves are telling you that the value of their business isn't reflected in their stock price anymore, and that's the company, the CEO saying this, you're gambling. You're gambling at a level that is so far beyond gambling. I laughed at my friends who face when they said GME is going to a million. That'll never happen. Um, that's such wishful thinking, even from the short perspective of like how much short interest is in those companies, because you have to understand, like, even if you crush all of the shorts, the stock isn't going to go to a million, and just like, it wouldn't even go to a million in the first place. But it's never going to stay up there, because there still has to be people willing to buy it at that intrinsic value. And if the CEO himself says, hey, the company's not worth buying here, they ain't doing share buybacks, they ain't doing anything. They're just going to liquidate and dilute the living hell out of your shares. And that's what they did. People are dumb. They're so dumb. They're like, oh my God, guys, we're going to make so much money. And then meanwhile, AMC, GME, they're like, hey guys, we can actually go, we can get rich again. Let's dilute. Let's dump all these shares on these idiots while they're being dumb. Just dump shares on them, dilute them. And that's what they did. And yet people still think it's going to be $1 million a share. Is nuts. Is nuts. I don't know. I don't play that shit. I'm going to finish up by saying, no matter what you're doing, no matter how you're managing your accounts, no matter what you're trying to do with your personal business, I'm always going to state this against your feelings, against what you like doing, what stocks you like buying, whether you like gambling, GMEs, or your Googles. Always, always take the path of least resistance to wealth. And this is a quote that I repeat in my head a lot, because you have to be able to recognize what is the path of least resistance to wealth, and having the emotional tolerance to take that path. The path of least resistance to wealth isn't leveraging half your portfolio in GME and hoping it goes to the moon. Leveraging over half your portfolio in Bitcoin is not the path of least resistance to wealth. The path of least resistance to wealth is you educating yourself, whether you like it or not, on things that people need to leverage, things that people are leaning into right now. That again comes into AI, websites, social media. On the stock market side of it, it literally coincides. Your Googles, your Apples, the products you're using. Yeah, they're expensive. Yeah, they might not double overnight, but I promise you, if you take that path, eventually it might not be astronomical income, but you will still be in a better spot than 90% of people you know, because you're not trying to be cocky about how smart you are at investing. See, I got lucky. I bought Canopy Growth Corp, MindMed. I took some calculated risk, and it worked out. But 9 times out of 10, it doesn't work out. And that's the shame of it all, right? Because people would rather take take the risk and take the slim chance of winning the lottery and getting fascinated by big dollars than just being patient. It's like Grant Cardone says, right? Like, I can't guarantee you're going to be rich tomorrow, but if you follow what I'm saying, I can guarantee you at some point you're going to be rich. It might take 15 or 20 years, but that's that's the give up, right? Like that's the give up. Do you want to bet it all and potentially go broke, or do you want to have a peaceful, easygoing life with the path of least resistance to wealth, understanding and utilizing your tax advantaged accounts, and just doing it, you know, doing it peacefully and boringly? Like, if it's, this is the best way you'll ever know you're doing something right, is no one gives a shit and no one's talking about it and it's boring to them. And this is literally what I do with my life. I do everything that people don't want to do because that's where you're going to make the money. And that's so true with websites and AI. How many of you right now even know that Google has an entire 3-day crash course on their machine learning program where you don't have to learn how to code? You know, the people that I know how to understand, use machine learning are all millionaires. Every single person that I personally watch or know that deals with machine learning are all millionaires. And you probably don't know the first thing about it. You probably don't even know the first thing about it. And it's all free to learn. All free to learn. Anyways, I'm going to leave it at that, folks. Stay cool. Stay awesome. Fun live stream. And I will catch you next Sunday. And yeah, we'll have some fun. I always love doing these. Peace out, everyone.